Hey guys, today I'm going to be reacting to Whole Life Insurance Scam, What Salesmen Won't Tell You. It's a video by Rich on Money. I watched it pretty fast this morning. I was like, you know what? This is a good video to respond to. And so what I'm going to do is I'm going to watch it. I'm going to watch it at 2.5 speed. So if this was like the worst decision ever made in the history of this channel, please let me know. And if it really is confusing, please let me know because I won't do this ongoing. What I will say is I tend to watch videos at 2.5x, and so it's really, really hard for me to watch at 1x speed, but I also understand that it could be really frustrating for you all. So what I'm going to do is I'm going to watch this. I may pause and give my 2 cents, and then I'm going to wait till the end and give a response. And the reason I'm doing this series is like, hey, listen, if we're going to be the one-stop shop for life insurance decisions, like you're on YouTube watching this, or you're listening to this on a podcast, and this stuff is out there, and this message is out there, and you're going to find that I'm not like, I agree with a lot of things that people say. It's funny because we're the one-stop shop for every life insurance decision, and majority of people should not get whole life. Majority of people should not get permanent insurance. Majority of people talk about life insurance being an investment, which it's not. So I'm probably going to agree a lot with what this person says, and we may have a little bit different perspective, but I do think you got to be really careful when you're dealing with someone that's incentivized to do one thing for you. We sell way more term insurance than we do whole life because even the people that come to us that go through our content, term insurance tends to be a way better option for them in the short term and long term than permanent insurance. With that said, huge fan of permanent insurance when set up and used properly. And so without further ado, let's dive into this. All right, we're going to be jumping into Rich on Money, the whole life insurance scam. And like I said, I'm going to be watching this at 1.5 speed. Let me know if this is a horrible idea, but without further ado, let's jump in and let's see what Rich has to say.
I am sick of salesmen pitching whole life insurance as a good investment. This is Rich from richonmoney.com, and today we are talking about the whole life insurance scam, what the salesmen aren't going to tell you about this terrible investment. Here are the supposed...
It's not an investment. I will say this to the day I die, but yes, I agree. It is a horrible investment. And if anyone's trying to sell you life insurance as an investment, please run. You will be disappointed. You're better off investing your money in something else. Life insurance is not an investment. 100% agree.
benefits of whole life insurance. A guaranteed death benefit that gets paid even if you die of old age. Level premium payments that never increase. A guaranteed and assumed rate of return that lets the cash value of your policy grow. Cash value to borrow against to fund investments or emergencies. Tax-advantaged growth, supposedly much like a retirement account. This sounds great, right? That is exactly why so many people get suckered into it. The strongest advocates of whole life insurance, which as far as I can tell are the people who sell it, claim it's a better investment than the stock market or retirement accounts.
And by the way, people do say this, that it's a better investment than your retirement accounts. And again, hopefully people don't quote me for saying that because it's not. It's not an investment.
This is flat out wrong. It is one of the worst and most complicated ways to invest that I can think of.
I agree.
People that sell this crap don't understand finances or investing. They understand sales and commissions. Their commissions are among the highest in the industry.
I also agree that if you set this up traditionally, like what most people set it up, you 100%. Huge commissions, and that's hard to overcome.
If you stay tuned till the end, I'll talk about limited cases when whole life insurance actually might make sense. If you want to understand what whole life insurance is, you need to first know what the much more common and useful term life insurance is. This is probably what you're already familiar with, and for most people, this insurance actually makes sense. A term life policy is where you pay a reasonable monthly premium for a set amount of years, say 20 or 30 years, and if you die during that time, you get a big payout. In my case, I paid about $40 a month and had $1 million policy. That price was good until about the age of 50, then the policy ends. Term life insurance is affordable because people don't die young. Most policies are never paid out. And then the insurance industry thought up something that could make them a lot more money called whole life insurance. Let's break each one of these benefits down. A guaranteed death benefit. It's true. Whole life insurance does have a guaranteed death benefit and term life insurance does not. If it's $1 million policy, you will get that million if you continue to pay your premiums. Sounds like a good deal, right? It's not. Look at how much you pay for this policy. These are quotes from a website that sells whole life insurance.
Everyone that does these videos, and I totally get why they're doing this. Dave Ramsey does this too. Like they're looking at whole life insurance, like they're comparing it, like you're either doing that or term. So it's like all these quotes and all these people that they're talking about are selling whole life insurance as a death benefit alternative, which is is not smart. Period. So yeah, I'm 100% in favor of this, and I would never recommend someone go to buy whole life insurance for death benefit versus term for death benefit, if that makes any sense. But I guess what I'm trying to say is I agree so far with what Rich is saying.
As you can see, $1 million policy will cost you $827 a month. That's like another mortgage payment. Seems high? It is. 10 to 20 times higher than an equivalent term life insurance policy. You can get $1 million term life insurance policy for less than $50 a month. Let me help you with the math. Whole life is 16 times the cost in this particular case. Why so much more? Because the term life policy is only for the first 30 years or so. You likely won't die during this period and won't get a payout. Here's the trick. They are charging you so much freaking money because they're gonna pay you when you die, even of old age. That's expensive, and for most people that understand investments, unnecessary. If you understood the ideal way to invest your money, you would know that by maxing retirement accounts from an early age and investing in...
Right. I also just have to say, yes, if the sole purpose of putting your money into whole life insurance is for the death benefit, you have to be super, super, super wealthy to be like, yeah, this makes sense because you're going to overpay, but it's for estate planning. So in that paradigm, so far, I would say majority of people shouldn't touch life insurance or whole life insurance at the 10-foot pole, just do term and invest the difference, because everything that he's saying is you're just comparing it to like assets where term is temporary. Most likely it's not going to pay out. Whole life is permanent. There's other benefits to that, which I'm sure he'll get into in this video. I believe, if I remember correctly, he's going to talk about borrowing against and some other things. And so I think he does touch on that.
Broad-based index funds, you will have a significant net worth, probably a few million, by the time you're 60 years old. In fact, it'll probably be much sooner than that. In my case, I was in my early 40s. By the time these much more affordable term life policies run out, you already have a significant net worth because you understand investing and you don't need this overpriced whole life policy anymore. Life insurance is something you only need if you die young, and it's much cheaper to insure for that unlikely scenario. Certainly, you don't need a $1 million payout at 85 years old. Your own investments will have made you a multimillionaire by then. Well, that's unless you waste a shitload of money on an
We'll edit the swear words out.
Unnecessary whole life policy. Let me explain exactly what I mean. Let's do a quick compound interest exercise that whole life insurance salesmen do not want you to understand. Instead of buying this whole life insurance policy for $827 a month, let's invest that money in an index fund for the long term. This happens to be how I've been investing for the last 25 years. If you invest $827 a month for 50 years in an index fund and it grows at 7% average per year, you will have 4.5.
I just want to point out, I do appreciate that they use 7% over 50 years. I think that's way more realistic than people that use 12%. And by the way, you could get more than 7%, but I do appreciate that it's not like trying to hyper, articulate that, you're going to earn 12% every single year without a down year. So I do appreciate that.
$5 million. If you buy a whole life insurance policy for $827 a month, after 50 years, you only get $1 million. Where did that other $3.5 million go? To your insurance company and your salesman. They thank you. Whole life policies only grow at about 4%, and you still pay that fat commission. This is where the whole life insurance salesmen really try to lure in those real estate investors. Something unique to whole life insurance policies is they have a cash value that you can borrow against. The cash value in your policy is growing with your premium payments as well as by the guaranteed and assumed rate of return. For many years, the cash value of your policy is less than the sum of your premiums because of the high commissions that need to come from somewhere. And commissions can...
Which I agree. That's why you should overfund and cut your commissions in 1/10 if you want to do it the proper way.
Be 50 to 100% of one-year premiums. Yep. Eventually, the policy starts making money, and you can borrow against that cash value for any reason you would like. You are supposed to be impressed by this ability to borrow against your own policy. They sometimes call this infinite banking. Banking on yourself, being the bank. They try to make you feel like doing this means you are outsmarting the evil banking system. That's actually a pretty stupid thing to think. Here's what I would offer. What if you had just invested the money yourself, making millions more than what your policy makes, and when you need the money, just...
By the way, I very much agree. I think a lot of people that talk about infinite banking and bank on yourself and all this stuff, they forego the math and they just make it all about like, hey, do this because we want to stick it to the Fed, or you like the idea of becoming your own banker, but it's like, you should only do that if financially you're better off. And I 100% agree. Again, we have different approaches, but knowing if I knew what this person knew, I would have the same video, because it's like, why would you buy into the hype if financially you're not better off? So I'm 100% tracking, and I don't think we got to be careful across the board that we don't get buy into any type of hype train, but we actually understand how the math works and understand how each product either helps us or hurts us as it relates to getting to our goals.
Take it out of your own account. You're not even borrowing at this point. It's your money. You'll make at least 7% in the market and millions more over a lifetime, as I've already explained, using index fund investing. This can be done in a normal brokerage account or in a retirement account. In both cases, you'll still beat the pants off a whole life policy. Why borrow money from yourself through an expensive, overcomplicated policy with unimpressive growth and high commissions for seedy salesmen? No offense.
See,
No, this ability to borrow from your own policy does not impress me. It appalls me. And the returns are abysmal for such a long-term investment. High commissions, 45% growth, just so you can borrow against it? I still think going to a real bank to borrow money is economically much smarter. Whole life insurance salesmen like to remind us that the premiums never go up.
Okay, I'm just going to comment on the borrow against. And one thing that he didn't even mention is a lot of people will say like, oh, like your money's compounding for the rest of your life, and let's say it compounds. He's using the word 4% or 2 to 4%. And a lot of times the loan rate's even higher than what your money is actually compounding in your policy. And so what some people in the insurance space will say is like, oh, but that's a good thing because your money will compound over your lifetime. And so even though you're paying 5% to borrow the insurance company's money, your money's only earning 3.5 or 4%, but that's still fine because you have lifetime compound growth. Well, yes, like you could make that argument, and human behavior could maybe be on your side, but mathematically, that's bad logic. It's like, why would I pay 5% to only earn 4? That's a negative 20% on my money. Like, that's not a good transaction. And so what I always say is this, and it's very, very important that we get this. If all we cared about is the growth, if that's the only metric we're looking at, and life insurance could only give me, let's say, 3.5%, and now a lot of these insurance companies you can borrow at 4, I would not do life insurance. I just wouldn't. It just would not. I mean, because yes, it's tax-free and other things, and so, but you have to stretch numbers. At the end of the day, why would I only earn 3.5 and pay 4 to become my own banker? Like that mathematically doesn't make sense. Now, with taxes and other things, you could create a scenario where it's like, oh, the 3.5% now is an equivalent to like 4.5 and all this stuff. But I'm like, from the standpoint, if you have to stretch the math, doesn't make sense. What we try to teach and what we try to help our clients understand if they go down this route is you have to understand that life insurance has other benefits, has a lot of other benefits. And even retirement experts right now are even talking about life insurance being a part of your retirement portfolio. Why? Because what this person's probably not going to say in his video is how you're going to spend your money, the 4% rule, retirement income strategies. Life insurance happens to be a pretty powerful asset because of the permanent death benefit, because it's a volatility buffer, because it has other riders that can enhance a future that, again, what is the ROI of having certain riders on your policy? I don't know, but they give you other options, and my philosophy in the future is more options, the better. And so overall, I just want to point out the fact that I agree from a standpoint of like, and he says life insurance salesman, and trust me, like I can relate. It's like, we get so focused on this one thing and we want to like push it. And at the end of the day, you have to take a step back and say, does whole life help me get to where I want to go and help me fund the mission that I'm on? If the answer is no, don't do it. If the answer is yes, then pursue it. And that's as simple as it needs to be. And all the other points that he's made so far is like high commissions, 100% agree. Zero cash value in the first couple of years, 100% agree. That's why overfunding cuts your commissions by like 90%, and you have a lot more cash value, you have a lot more flexibility, the growth is a lot more. Guess what? The biggest difference is the commissions are a lot less. And so it's just one of those things where I think we're more in agreement. And you have to be, when you make a video like this, you have to be super, super careful because 98% of people that do life insurance, permanent life insurance, aren't doing the overfunded way. Now, this person might still be not in favor of overfunding, but he would say if you're going to do life insurance, you should overfund and not do a traditional policy. I think everyone would be in agreement on that. And then it really just comes down to splitting hairs and saying like, all right, which is better? So without further ado, let's jump in.
And this is actually true. But here's the problem. In the example I just talked about, the whole life policy is more than 16 times more expensive than a comparable term life policy. Of course these premiums never go up. They're already sky high. Here's another big issue with these premiums. Let's say you lose your job for 6 months. You'll need to come up with the $50 a month so you can keep your term life insurance policy for $1 million. No big deal. In case you die and you can help your...
Yes, if we're talking like traditional, off-the-shelf, horrible permanent life insurance that has almost zero cash value, or like a universal life policy that's not set up properly, and you're like, later in your life you lose your job, like, yes, you might have to come up with money. But if you overfund this, a lot of times our policies in the first year have enough cash value to quote unquote land the plane. And so we are hyper conservative by having cash value. And one of the things that you can do is that cash value can be used for flexibility. And the life insurance salesman will say that this is actually a benefit because it gives you options. You can start things, you can lose your job, whatnot, and you have access to capital. There's other riders that you can also put on there that will pay your premium if something like you get disabled happens. And so I just want to point that out.
Your family out. What are you going to do about your $827 obligation for whole life insurance? You won't be able to pay that. When you stop paying, you surrender the policy and you get your cash value minus penalties.
There's so many other options than surrendering. Surrendering a policy later in the future is like the worst thing that you can do. So if you're thinking about surrendering your policy, I would highly encourage you to just reach out to our team because there may be like a easy switch that you can do that could help you big time in the future. So at least have a second opinion before you surrender a policy.
This causes an already poor investment to get worse. You don't get the death benefit.
Not an investment.
You may get taxed on money you thought would be tax-free, and you may have losses that you can't deduct. Surrendering whole life policies ends up happening to more than half the people that take out these absurd plans. They realize it's a raw effing deal. Now let's shift to the next over-exaggerated benefit touted by whole life insurance salesmen. Again, no offense to these salesmen. They've got to make a living. These policies typically have a guaranteed rate of return on the cash value of the policy of at least 2%. The return should be higher than that, and usually are. They also give you an assumed rate of return that might be 4%, maybe 5%. The cash value of your policy will likely grow at some rate between these two numbers. While that's not a bad rate of return compared to a savings account,
I'm glad he mentioned that compared to a savings account because you should never buy this as an investment, but as an alternative place to store capital. Like this person's putting money in a savings account and then reinvesting right away, and that would be a conversation that if life insurance got you more benefits than the cost of borrowing, then you have the arbitrage of having $1 do more than one job. And so that is really the ultimate, like if life insurance was not an investment and it got you more benefits than the cost of controlling that capital, and you use your own logic with 7%, you'd be better off because now you have $1 doing two jobs rather than one. If it's not, if life insurance only gives you a quote unquote benefit of 3 and it's costing you 4, then you're better off just buying term and investing the difference. But that's where all these conversation has to come back to. It's not an investment, and a lot of people don't compare the simulation, compare it properly. And so that's the toughest thing as someone that's, against majority of people in the life insurance space. But knowing what I know, it's like, man, we should have a conversation because I think we would agree on 95% of the areas. We can agree to disagree on some, but we can both say, hey, both of these approaches based on your mindset could be better if you had the right mindset going into it.
It's a really crappy return for decades of investing, or even a lifetime. As I've already covered earlier, if your investments grow at even 7%, and more is probably likely, you stand to make far more money investing it yourself in the market. In my earlier example, you make 4.5 times more money investing it yourself over 50 years. As stated before, you can borrow money against the cash value of your policy. While you typically pay interest for this privilege, this is a tax-free loan. Salesmen like to emphasize this tax-free loan as an amazing benefit for real estate investors. It isn't really a benefit, as all loans are typically tax-free. To say it's a benefit is stupid. When you borrow money, you still have to pay it back. That's why it's not taxed. But what about the death benefit? Advocates of whole life insurance policies, which are very few, will talk up the tax benefits of this policy. Let's understand this. They say that when the death benefit is paid, it is generally not taxed as income. Well, isn't that something? Actually, it isn't something. Almost any death benefit of any kind, including the 16 times cheaper term life insurance policies, are also tax-free payments. Sorry, whole life salesman, but this is not a unique tax benefit. But there's tax-free growth, right? The cash value of your whole life policy is not taxed while it's growing. This is a good thing, and similar to how retirement accounts work. But the problem with this is you don't control the money. Another is it grows.
I love how he says you don't control the money. I'm assuming he's saying like you don't control it because you can't determine where you're investing in it, but you have a ton of control because you can borrow against it and your money continues to grow. And that's a talking point of an insurance salesman. Like if you actually understand how that works, it's actually pretty cool. And again, I go back and back to back and say, it's not just about what you're earning and what you're paying. It's important, but there's so many other benefits. And if you don't care about any of the other benefits, then don't do life insurance because then there's other ways to arbitrage your money that's like maybe a little bit more riskier, but a lot better if that's all you care about is the numbers.
A lot slower than it would if you were invested in the stock market. If you invest your money in either an IRA, 401k, TSP, or other type of retirement account, it will likely grow much faster.
I agree.
And also have tax-free or tax-deferred
because they're investments.
Bottom line here, retirement accounts are superior investments to whole life insurance.
I agree.
This is not an opinion. It's a fact. If you are foregoing investing in retirement accounts to stuff money into your whole life insurance policy and stuff money into your salesman's pockets, you're a sucker. Whole life insurance salesmen are going to love you and buy a vacation home in the Bahamas off their commissions from you. So when is whole life insurance right for you? Well, one example that I can think of is when you have a special needs adult who cannot earn money or take care of themselves. If they're going to live with you for your entire life, and could use an infusion of tax-free cash when you die, then this isn't the worst thing in the world. I still think it's better to invest the money yourself and then just give them what they need. Another possible situation is you have already maxed out your retirement accounts, plenty of money in taxable accounts, significant real estate holdings, and you still got shitloads of money you've got to park somewhere. Okay, whole life then. I wish I had this problem. Whole life insurance policies are pushed by salesmen as a great investment or tool for helping you achieve your financial goals. Unfortunately, they often try to claim these are superior to standard retirement accounts and try to convince you to forego investing in TSP, IRA, 401k in favor of these insurance products. They are inferior investments, scams if you ask me. All right, look at my recommended video here and...
Yeah, I mean, inferior investments, scams, and trust me, I see a lot of people trying to push different products like life insurance over investments, and they sell it like investments. I won't name his name, but there's someone who has videos that's seen by a lot of people that are bad mouthing other things, pushing life insurance, and the whole sales pitch essentially is life insurance is better than your investments. And I fundamentally just have a problem with that, because I do believe that people are going to be disappointed that they're overpitched. Even though there's some good points to them, and in some cases it could outperform an investment, I would never buy an insurance product for the hopes or the pitch that it's going to outperform investment. So it really just comes down to this, and I love the buy term and invest the difference. Person A, buy terms and invest the difference, has a nest egg and spends it down, or whatever their investments do, like, go for it. Like, if that resonates with you and you're actually going to invest the difference, I would do it. Like, I think and buying term insurance to protect your family, your obligations, is a great idea. So I think you should do it. Whether you work with our company or someone else, like, go do that, and that's awesome. If you're going to do whole life insurance, or if you're going to do permanent insurance, make sure you're overfunding it. Make sure you're maximizing it so that you cut. So majority of things that he said are not as big of a deal. You have a lot of cash value in the first year. You have a lot of flexibility. You don't have to worry if something happens to you, because you'll have equity built up in the policy. It cuts our commissions significantly. And if you understand that life insurance has more benefits than just the boring old 3.5% lifetime tax-free growth rate, and you understand the tax-free benefits and all the other benefits, you might find that you will value that life insurance asset more than the cost of borrowing against it. And you might see that having that asset plus the activity of controlling capital is better than buying term and investing in the difference. And if you don't understand what I'm saying, I would probably buy term and invest the difference. And also, I've said this publicly, I get a lot of flack from people in the insurance industry. If you don't have like more than $5,000 to $10,000 a year that you can afford to save money, I wouldn't look at permanent life insurance, which, by the way, wipes out a ton of people. And so overall, I agree with, what's his name? Rich. I agree with Rich on money, more than you may think. Hopefully I wasn't super critical of the video. I think this person communicated quite well, and I think it gives a really good opinion. And at the end of the day, if you resonate with this, I think you should go the buy term and invest the difference, because a lot of people aren't going to challenge that, because that's what we're all been taught. Like, to have this opposite opinion creates more friction, and it would be a lot easier for me to just be the buy term and invest the difference person. Like, I see that, and I think majority of people should do that. And saying that, and also saying, well, I also have money into life insurance, and I don't look at it as an investment, but a place to store capital, like, it's not the easiest road. So I don't know if this video was helpful at all. Love to hear your thoughts. Love to hear from you from a standpoint of, like, what other videos should I react to? And let me know if the 1.5x speed was, like, really distracting. If you guys liked it, let me know, because I would react to way more videos if I could watch these faster, because we only have one life, and I don't want to spend I want to limit my exposure to negative videos, and I also think they're super important, and more people that are in my position need to do that, because we need to have conversations across the aisle, different viewpoints. It makes everyone better, makes us less polarized, and I think overall people are going to be better off financially, having just different opinions. But overall, hopefully you don't think I was super critical or super, like, triggered. I think this is a great video, and Rich on Money, love to have a conversation with you sometime, and I'm sure we agree across the board on most things as it relates to money.